Alright, so now we start with part 3 of chapter 5. We're talking about charity here, deductible gifts to charity. So, just to clarify, charity does not mean giving to panhandlers on the street. Okay, that's a lovely thing to do, but you're not going to get a tax deduction for that, okay? Also, to freeloading friends also does not work. For something to be deductible, it has to actually go to a qualified charity or other not-for-profit. Okay, those are organizations that actually have to furnish a great deal of information to the federal government, entailing how they use the funds that they've been given. Okay, so there's some accountability there, whereas if you give it to somebody on the street, there's no accountability, and the government doesn't want you taking a tax benefit when there's no accountability. Some general things as far as charity. There is a ceiling. Okay, we talked about medical in part 1 and how there was a floor where you had to spend over a certain amount before you actually get any tax benefit. Well, this actually has a maximum 50% of AGI, 50% of your adjusted gross income. That's the maximum tax benefit you can get, and that's before 2018. So beginning or / after January 1st of 2018, I believe they've raised that threshold to 60% of adjusted gross income. But for all your calculations, like on your tests and everything, you can just remember the 50%, and that's fine. The other big thing is as far as documentation. Okay, it's very important to keep records. So any contribution that's greater than or equal to $250, you need to have a receipt from the charity acknowledging the contribution. And one important thing that has to be on there, apart from like information about the not-for-profit, the charity, etc., they need to also say specifically that they did not provide any goods or services in exchange for the donation. So basically, you didn't get a tax benefit for it. So sometimes if you're going to some charity benefit, some charity ball, whomever you paid the donation to, they'll actually put the estimated fair value of that banquet / charity ball you're going to, because it's basically you're paying to go to a party for a portion of the donation, and then the rest of it is donation, and truly, yeah. Other than that, if you're not donating cash, so this is mainly around cash donation. If you're donating property, okay, so let's just kind of group this as cash. If you're donating property, there's a different thing that applies. So they've got a different ceiling. They've got this 30% ceiling if it's property. And they make a distinguishment between if it's going to be long-term capital gain property or if it's going to be ordinary income property. Now, what the hell does that mean? So long-term capital gain property, those are things that you've held for more than a year, and that if you sold them, they give rise to a long-term capital gain. And then ordinary income property, that would be property that you use in the ordinary course of business, such as inventory that you're holding for resale, or that you've manufactured and are holding for resale. And then also, if you're a cash basis taxpayer, any cash basis accounts receivable you have is also ordinary income property. So there's different thresholds for those. So if it's long-term capital gain property, it's going to be 30% limit. But the thing is, you get to deduct the fair market value. If it's ordinary income property, you're limited to the basis, and we're always assuming that the fair market value is greater than the basis. If you have lost property, you do not want to donate lost property. So that's where basically the value... That's where basically the value is lower than the cost. So if you have something that's worth $100, but it costs you $150, well, you have $50 in lost property there. if you donate that property, you're not going to benefit from that $50 loss at all. So if you're donating long-term capital gain property, but it's not really at a gain, it's at a loss, you want to just sell that and donate the proceeds, because if you sell it for what it's worth and then you donate the proceeds, you'll get the same tax benefit as far as the donation is concerned. But then on top of that, you have long-term capital gains, long-term capital loss that you can harvest and use against long-term capital gains. And we'll talk more about capital gains and losses in later chapters and how those work. Okay, yeah. So again, for these two deduction amounts. Okay, remember those are subject to the ceiling. So the fair market value one would be subject to the 30% ceiling. The basis one would be subject to the 50% ceiling. But we are assuming that fair market value is greater than basis. And remember, we're going to assume that in all these scenarios because we're assuming that the person's not going to want to donate lost property, that they're going to sell that and then donate the proceeds. Another thing to note about property donations, because of a lot of abuse in this area of property donations, people would donate like used tires and claim like the full value, like the full cost of the tires as a donation, which you can't do that. So they have an extra form that you have to fill out if you donate, I think, more than $500 or greater than or equal to $500. If you claim more than that, then you have to do an additional form. You have to provide additional detail on the not-for-profit you donated to. You have to have receipts. You have to have some kind of estimated fair value that you came up with and identify how you came up with that fair value. Some stuff like that. And then it gets even more complicated if you donate property that's over $5,000. You actually have to get an appraisal done for something over $5,000. And they have that in your book, that form, the 8283, for any non-cash donations over $500. So yeah, it's just greater than, not greater than or equal to. Okay, let's go ahead and take a look at a problem and apply some of this. So I guess we can go back to the part 2 real quick because I just saw one that caught my attention. Take a look at number 53. It talks about some items for loans, and the only thing that I see in this problem that's deductible is the interest on the home mortgage. The principal is less than $1 million. So the stuff on the municipal bonds, since the interest coming from municipal bonds is tax exempt, we talked about that in an earlier chapter, we're not going to get to deduct any interest on that. So the government doesn't let the door swing both ways where you get a double tax benefit. If you're incurring interest expense to give rise to tax exempt income, such as that of state and municipal bonds, then you cannot deduct the interest associated with that. Interest on the car loan, that's personal, so we cannot deduct that. So on that one, we'd only get to deduct $2,100. Next, we're going to move on to some awesome stuff. Let's look at number 58. So number 58 is another home interest question, or interest question. How much is deductible? So credit card interest, definitely not. That's personal. The home acquisition debt that they say is less than $1 million, and the home equity loan of credit or line of credit that's less than $100,000. Both of those are good. And the investment interest expense up to investment income of $2,000. So out of those, we would have the home acquisition debt of 15, the home equity line of credit, interest of $6,500, and $2,000 of the investment interest expense, since that's all the investment income we have. Let's say 21.5, 23.5. All right, and let's do number 60. So that's an actual charity question. So number 60 says you make a... Oh, it's in the... Oh, no, it's not. I'm sorry. I'm on drugs. So Tom made a charitable contribution to his church in the current year. He donated common stock valued at $33,000, acquired as an investment in 1998 for $14,000. Okay, so that's not lost property. The value is greater than the cost, so we're good. And then his AGI on the current year was $75,000. What is his allowable contribution deduction? How is the excess amount treated? Okay, so let's calculate 50% of his AGI. So 75,000 times 50%. Okay, I'm thinking this is, oh, I'm sorry, it's 30%, because this is the long-term capital gain property. We're going to use a 30% threshold. So 30%, that's going to be 22,500, I believe. Let me get a calculator out just in case. Shoot, okay, hold on a second. It's gotta be. It's gotta be. Yeah, I'm just gonna go with it. 22,500. Yay! Okay, cool. Alright, so that is our limit. The value that we donated was $33,000. So long-term capital gain, we're gonna use the fair market value. So we subtract our ceiling, and then we have this excess of 10,500. Well, what can we do with that? All right. Well, basically, this is going to be carried forward for up to 5 years. So since we didn't get to benefit from this 10,500, so we took a benefit for the 22.5 in 2016. So this other 10,500, we have 2017. So that's basically, yeah, through 2021, I believe. Just in time for my 40th birthday. Oh gosh. Yeah, so that's 5 years, 17, 18, 19, 20, 21. So if we don't use that carry forward by the end of 2021, it's gone. It is dead. Okay, and when you are taking deduction, they incorporate your current contributions first before incorporating the carryover. So make sure that you gauge your giving to make sure you benefit from that carryover of 10,500. Yes? Yes. Okay. Awesome. All right. Okay. All right. Another. Let's talk about an exception to this fair market value thing. Okay, so as far as the long-term capital gain property, the deduction equals fair market value. Okay, there's an exception to that. Okay, so we have, without even thinking about the 30% ceiling, so the exception is if you've got tangible / personal property. Okay, and so you're donating that, and it's put to unrelated use. with this, unrelated use means, okay, if you're donating an expensive work of art that you've had for years and years and years, you donate it to a museum, and then the museum says, you know what, this painting that we just got donated to us is worth millions of dollars. So rather than just display it in our collections, let's just sell it, dude. Let's pocket this cash. Let's use it to finance our operation, expand the museum, do some wonderful things with these millions of dollars that the art is worth. Okay, so now if they do that, the deduction is going to be limited to basis. And remember, we're always assuming that basis or cost. Okay, so you can look at this as like cost, how much money you have in something. We're going to only get to deduct up to that amount instead of the higher fair market value. So think about, like, the example we just looked at in the book with the stock. Okay, well, you can't really do much with stock, okay, other than just sit and watch it grow and pay some dividends every now and then. But you can't do much else with it. You can't hang it around your house and show it off to your friends and stuff. But with art, okay, that's a tangible thing. I can actually hang that on walls and stuff. It's not just floating in, my bank account or just floating around on the internet in my portfolio. It's actual, we can see it. It's an actual factual thing that we can touch and feel. So that is, it has to be put to whatever the organization's exempt function was. So the museum exempt function is to display art for the public. And if they don't do that with what I donated to them, then we're going to be SOL as far as taking that higher deduction. Now, how would you control them? Hell, I don't know. Talk to your lawyer and have them draw up something that says they'll hang on to it for a minimum amount of time before the statute of limitations runs out. Other than that, I don't know. Okay. Let me go back and see if I missed anything. Yeah, we talked about all this stuff. Okay, casualty and theft. So I think we can roll through the rest of this pretty quickly because most of the rest of the stuff I'm not going to test you on. You might have a couple of homework questions to deal with it, but it's not going to be in your test. So let's. So you can't take casualty or theft anymore. Basically, if you want to protect yourself against that, you just have to make sure you got good insurance that's going to protect you against any losses. Otherwise, you're just going to have to accept the risk of loss. Okay, so if you've got a bunch of expensive stuff in your house, or your house itself, okay, you want to protect it because it can burn down. And if you're not willing to just accept that loss and your house burns down, then you may make sure that you outsource that risk by purchasing insurance. So same thing would apply with anything else. Like you can kind of gauge it like an example of where you would accept risk is in a vehicle. Okay, if it's brand new, you want full coverage on it. Or if it's a relatively new vehicle, you want full coverage. Because if it costs you $15,000 and you total it, well, you don't want to accept a $15,000 loss. But if you're driving a beater, like I am, maybe it's only worth a couple of grand or less. So if I can save a few $100 a year on not having full coverage, just liability only, and I total it, I know the probability is there. It's not that high, but it's there that I can total it. I'm willing to accept that, and if I win the lottery and total that vehicle, then boom, I'm out $2,000, and then I'm going to be taking the bus for a while. So casualty and theft, the only reason, starting in 2018 with the tax reform, they basically changed it to like the presidential declared disaster areas. Okay, so if it wasn't declared a disaster area, you're not going to get any tax benefit for it. So like when we had the wildfires here in Austin, Travis County, then yeah, in that case you could get some tax benefit from it. But if it's just a normal old thing where you get some stuff robbed at your house, not going to get any benefit from it anymore. Before you could, but now no. So we can skip through all that. I'm not even going to do an example. Miscellaneous, okay. Miscellaneous, they had a 2% floor category. This is also gone. Okay, so there was all kinds of stuff umbrellaed into this miscellaneous category. So you saw a couple of them that I plugged in one of the tax return walkthroughs. And some of these assignments we do, we'll continue to see, and I'll talk about those as I do the tax return walkthroughs. But because I'm not really going to test you on this miscellaneous category, I don't want to spend any time lecturing over it. So if you want to read about it, then go for it. But as far as most of the stuff in the miscellaneous category had to do with unreimbursed employment expenses. Now, if you want to get any benefit from any job expenses, you just have to make sure you get reimbursed for them. Okay, so if you have mileage on a vehicle, make sure, okay, it's like something you can get reimbursed for from the company, because the company can take a deduction for it, because they'll require you to submit expense reports and things like that, receipts, documentation, and then they can take a deduction and then reimburse you, and then you don't get taxed on whatever you were reimbursed for. But you don't get to take a deduction for it anymore. Okay, and then the limitation on itemized deductions. At a certain level of income, your itemized deductions get reduced. Beginning in 2018, you're probably not going to see as much of that. I think the reforms made that less pervasive, to where more people can benefit from itemized deductions. All right, that's it. That's chapter 5. I hope you enjoyed this and got something out of it and learned something. Email me with any questions.